Call option strategies. There's several of them. You don't need to call that way, but just in case you do, that's how you go about doing it. There's four types of calls. There's a long call, a covered call, a bear call, and a bear put call. So you have four different types of calls. It depends what you're doing and really the strategy that you want to have with it. So when you talk about an option, it gives you the right but not the obligation to buy an asset at a strike price on or before an expiration date. A long call is the simplest. It involves buying a call option on the asset you believe where the price is going to go up in price. That's a long call. You believe it's going to go up in price, and if it does, you're going to profit by buying this long call. So the price of the asset goes up above the strike price. You exercise your option and you buy it at a lower price and sell it at the current market price, and you make money. It's that simple. Of all of them, it's the simplest and easiest to understand. You make a profit because you buy the asset at a lower price than the market price. However, if the price of the asset doesn't go up or it goes down, you lose your money by the time it's done. Or you can exercise it, but that would be nuts to do that. So you lose the premium you pay. So you're taking a risk. So a covered call is different. You're selling a call option against the asset that you own. Is called the covered call. You use it to generate income or protect your profits if the price of the underlying asset declines. A covered call involves selling a call option against an asset you own. Okay, it's used to generate income or to protect your profits. So you sell it. Okay, you sell the call option to somebody else that is going to do a long call. So it depends what you're doing. So that being said, you're going to use that the long call. You want to sell it to somebody over here. You may think it's going to stay the same and not hit that price. So you have the asset over here. Let's say $50. Okay, is where it's at today. You sell a call option for $60. This person on the long call, they buy it for $60, anticipating it's going to go to 65. Your stock goes up to 55. You're still making money, and you made money by selling the call option. So you're walking away with cash money. And even if it goes to $60 that you sold it for, you're still going to make money. This person makes money, so you're all good. But if you're sitting down there, you have it at 50, and it goes up to 75, and you sell it for 60, you're going to be kicking yourself nonstop. Saying, that's the danger. So if you're going to have a long call, you're out over here and you're making a bet that the stock that you just bought the call option for is going to go up more than you paid at your strike price. If you're selling the right to buy that, you're selling the call option for it, and you're trying to sit down and doing a strategy so that if your stock goes up or down, you're making money off of it. And if it expires, let the person exercising it, he just made some cash money on the side. And then you have, by the time you're done, you have that, you have a covered call. It's the price of the underlying asset goes above the strike, price. The buyer of the call option will exercise the option, and you're obligated to sell the asset at that price. So if it goes down, then you have to sit down there and make certain you have the whole aspect. It means you cap your profits, but you also limit your losses. So by the time you're done on the covered call, you have different ones: long call, you have a covered call, and that way you're covering over here. And now you have a bull call spread. So that being said, you're going to buy a call option with a lower strike price and selling a call option with a higher price by here and here. That way you're making a moderate increase in the pricing of the underlying asset. You sell it on both sides, and that way somebody can buy it no matter what happens. By having the spread strategy, you're buying a call option with a lower strike price and selling a call option with the higher strike price. This can get really confusing. It's a lot of bull to do it this way. Did you hear that? Just in case you wanted to horn in, feel free. Anyway, so the bull call spread, lower strike price, and also sell call option at a higher strike price. You're having a spread between them, and that way you can sit down there and have it depends where it's going. You're going to make money, first of all, selling the two options, but also you have some insurance policy in the process as well. We call that a bull call spread. So that way the maximum loss is limited by the premium paid for the long call option. Now, a bear put spread. Okay, you're going to sell a put option with a lower strike price and buying a put option on top with a higher strike price. We call it a bear put spread. In other words, including the put option in it. So similar to the last one, except now it's a put. So you use a profit to moderate the decrease in the price of the underlying asset. You're almost better off mapping things out when you're doing this, because no matter what you do in a spread, okay, number one, you need to have experience doing the options to begin with. And then once you have the experience in the options and you're comfortable doing them back and forth, then you start playing with the spreads. If you do it, just dive right in, you'll get so confused. Everybody will be laughing at you and taking your money out of your wallet and putting it into theirs because you don't know what you're doing. This is the more complex aspect because you're selling put options with a lower strike price and then buying a put option with a higher strike price. So by the time it's done, you're going to sell the put, buy a put. So you have all that aspect of it, and you're watching it in the process. So that being said, the bears are out there and the bears are watching you, and the bears will have you for dinner if you sit down there and do a bear put spread in the wrong way. So between the two strike prices, you sit down minus the premium received for the sell, you're going to have the differences between the two of them. You're going to make some money in this deck, and you're ensuring the overall value you have of the stock itself by playing games with the different types of spreads that you have. There's lots of different options out there. Really, they're available. The best strategy for you will depend upon your goal for investments as well as your risk tolerance. These strategies with the spreads are very risky in the process because they can be confusing on a good day and things will be jumbled so much. And then if you have different types of spreads going on at the same time, you may lose track of things. Make certain that your advisor initially works with you on it, or your AI, depends how you want to go around structure this, but also in the aspect of make certain you're comfortable doing options before you dive into the spreads at all. Otherwise, you'll be seriously damaged financially if you don't pay attention to all the details, which is what the spreads are all about. Take care.